This is 15 with Fallon, and what we do here is we do quick little trainings, 15 minutes in and out to keep everyone up to date on what's going on in the industry, tips and strategies that you can use to help close more deals. And today we're going to be talking about credit. Credit is such a huge part of the buyer's experience in the pre-approval process. So I think it's very, very important for us to kind of go through some of the myths that you may have heard in the past. There's a lot of questions that surround credit scores. And this is actually very common because there's really no way for us to like dig in and see the algorithm specifically on how everything is weighed. So there is some mystery to it, but we're going to clear some of that up because there are some set rules and percentages that the credit bureaus will use to determine a buyer's risk factor, because that's basically what a credit score is. The credit score is a way for the bureaus or anyone who's lending they can take a look and they can see how risky this buyer is. Do they pay their bills on time? Do they have a high credit outstanding? So that's typically what it is. Now, it's important for what we do here, you as a real estate agent and me as a lender, because the higher the credit score, typically the lower the interest rate, so the more house that they can afford. And also on top of that, the higher the credit score, typically the more loan options they have. When you have a lower credit score, you're either not able to get approved or not able to get approved for as many options. So again, this is why we want to make sure that we are addressing any questions that they may have before they go under contract. So just to get started, let me pull up this right here. All right. So the first myth that I hear a lot is if someone is talking about credit score and if do they know where their credit score is? And a lot of times I'll hear, no, I don't really know because I don't want to check it because I know that if I check my credit score, it's going to hurt me. And that is actually not correct. You as an individual, if you check your credit score on something like Credit Karma or annualcreditreport.com, it is not a hard inquiry, which means you will not get that ding that a hard inquiry will give you is if you're shopping for a house, shopping for a car. It's not the exact same thing. It's considered a soft inquiry. And I do actually 100% recommend everyone to monitor their credit score on a regular basis. Even if you don't have a lot of outstanding credit, you should still be looking at this because, for instance, Credit Karma, if there's anything new that opens up on your account, you're going to get alerted and say there's a new account on your credit report. And it kind of helps monitors, what's going on. It helps with the possibility of identity theft. If something you didn't even realize that something fell through the cracks and there's a late payment on there, you want to know that as soon as possible. That way it can be addressed. So yes, it is true that Credit Karma and the credit score that maybe your bank gives you, they're all going to vary a bit from what a mortgage lender pulls. But the good news is it's going to give you at least a range. That way you can see if it's going up or it's going down. So definitely recommend keeping track of that and monitoring that regularly. Another myth is no debt means you'll have a higher score. Also, believe it or not correct. So I have a lot of borrowers that they say, well, I don't have any debt. I pay everything cash. I don't want to owe anybody anything. And look, that is fantastic. That is amazing. And that means you really have your finances in order. However, when it comes to borrowing money for a mortgage or a car or something like that, when they go back and they look at your credit, if they don't see a credit history, then they don't necessarily know how to grade you on your risk. They don't know that you've been paying all your bills on time. They don't know any of that because it's been all under the radar with cash. So although it's fantastic that you're able to do that and not take out lines of credit, in circumstances like this, when you're trying to get a loan, it could affect you negatively. Now, there are ways to combat that. You can open up a credit card, a small line of credit, a secured line of credit, just maybe even a revolving line of credit at a department store, or a small personal loan, and you can help build that credit pretty quickly. So it's not necessarily true that if you have no debt that your score is going to be high. You may not have a score at all, which in most cases, in most loan programs, you'll have to develop one or work on getting a score in the system before you can get approved. All right, so a lot of people think it takes years to build or rebuild credit. And also, this could be the case if there is a lot of issues on the credit report, maybe some bankruptcies or things like that. Sometimes there is quite a long waiting period for that to rebuild. However, if you are struggling with credit, I've seen many buyers, they will come to me, we'll pull the credit, we'll take a look at it, and it's not where it needs to be, and maybe it's not approvable. But when I run a simulation for a rescore, we can get steps, and with paying down one or two of the cards a little bit, or maybe even in some cases opening up a line of credit and keeping a low balance on it, can jump their score up quite a bit. I've seen 50+ points within a month. So that's not necessarily true. It doesn't take a whole lot of time in some cases to build credit. So don't let that be a reason that your buyer says, I'm never going to be able to buy a house. I just want to rent because I know that it's going to take me a long time to build my credit. Another thing that I'd like to add to this too is a lot of people will say, well, I'm young, like my younger borrowers will say, I'm young, so I didn't really have time to build credit, and that's why my credit is not so great. And that is also fiction, because I have a lot of 18-year-old, 19-year-old borrowers that have fantastic credit scores with not a very long credit history. Just everything that they've done in that period of time they've paid on time, they've kept everything up to date with low balances. So if you have zero credit or even bad credit, talk to someone as soon as possible. That way you can make sure that you're on track to get it where it needs to be. A lot of people pay off their credit cards every month. So if they charge it up and then every month pay it down to zero. And I am not against that. I think that you're doing a fabulous thing. However, in this world of trying to get a mortgage, it's not hurting you, but it's also potentially not growing your score. So again, back to this algorithm that the credit bureaus use, they want to see that you know how to manage your money. So by not keeping a balance on there, they're not seeing you manage it. They're just seeing that you're paying it off. By keeping a little $10 balance on your accounts at all times, it actually helps you more than having a zero balance, and you could possibly see your score creep up. So just something to keep in mind. $10 balance. To be like more specific, if you are maybe paying something down to like less than 30%, it's helping your score. Okay, so let's say you have $100 limit on your credit card and you are keeping that balance under $30, which would be 30% of $100. It is going to help you. However, I say the lower the better. So if you can do 10% of it, or if you can do, less than that 30, even better. So keep that in mind. When people try to work on their credit by themselves without someone helping them through, a lot of times they will go for paying the highest balance that they have first. And that doesn't necessarily help as much as maybe paying one of the other debts, because again, it goes back to that limit ratio. So if you have a $500 card that you have the limit of $500 and you have one that is $100 balance, sometimes it's easier to pay that $100 balance down. So that ratio is easier to put a dent in than maybe paying the higher balance. And again, this is something that, as a real estate agent, you shouldn't have to work with them through their credit, but you should just familiarize yourself with it and maybe put them in touch with a lender that can advise them in the right way, run a simulator to know this is the next steps. This is the quickest way to get you where you need to be. All right, so when you pay off the debt that you have on your credit report, it is not removed. So if you have a late payment that you catch up on and you pay it off, that late hit that hurt your credit score will not go away. It's going to stay there for years, 7 years. So yes, the impact of it will lessen over a period of time, but the damage has been done. And by paying that, it's not going to remove it completely. So that is something to keep in mind. Now, you do need to pay your bills and make sure you keep up, but you need to try to do that on a regular basis. Don't let them slip, because one late payment can set you back quite a bit. Just to put it in perspective, when you're looking at the breakdown of how credit score is determined, 35% of the score, and this is the highest percentage breakdown, 35% of your score is based on your payment history. So you want to make sure that every payment that you have is paid on time. And one of the best ways that I can advise to do this is try to have everything set up automatically. But then after it's set up to auto pay, make sure you're going in there every single month and making sure those bills have gotten paid and it shows on your subscription that it has been paid. If you try to do everything manually, sometimes one or two will slip through, and you don't want any lates on your credit report, especially when you're trying to purchase a house. So paying off your collections and charge-offs will not necessarily increase your credit score. In fact, it may actually decrease your credit score. So you have to realize a lot of these collections, they're old. They've been sold to third parties that are trying to get their money, right? So by paying this off, you're reopening that wound. So it looks like a fresh negative entry on your credit report, and anything new like that's in default or against your credit is going to drop that score. So before you do that, and again, I'm not saying not to pay the money that you owe, but you do want to talk to someone, because there is a right and wrong way to pay off these collections whenever it is time to do so. I just don't want you to put yourself in a situation where you're no longer able to qualify for a loan because the score has dropped. Closing old accounts does not help increase your credit score. Also, you may have a credit card that you haven't used in a while, or you don't want to use it because you finally got it paid off and you're like, okay, it's got a zero balance now. I don't want to be tempted to use it, so let me just close it out. That will more than likely decrease your score, because another factor that the algorithm is looking at is how long have you had these accounts open. That makes up for 15% of your credit score when it comes to the algorithm. So when you close out that account, you lose all of that history. So keep the accounts open. Again, you can have a zero balance on them. You can keep that $10 balance on them, but do not close them out, especially at a time when you're trying to get financing, because more than likely your score will drop. So if you're a co-signer for a friend or a family member, that will affect your credit. I get it told all the time, well, yeah, I'm a co-signer on that car, but it's not my debt and they were late on it, but that shouldn't affect me. And that is not the case. If you're a co-signer, you want to make sure that whoever you're co-signing for is paying their bills on time. If they are not, it's going to count against you, whether you're the main borrower or not. You backed this person, and you will be affected if there's anything negative to that account. So just make sure you're aware of that. Your credit score is not affected by your income. So the myth is that the higher your credit score, typically the higher your income is, or vice versa. And that is actually not the case at all. They are not taking the credit bureaus are not taking your income into account. They are only taking your debt that you have into account. So if you're keeping high balances on that debt, on your credit cards, that's going to affect you, but your actual income does not affect your credit score. And last but not least, and this one is one that I definitely hear all the time, and I'm sure you do too, is that I don't want to talk to a lender just yet because they're going to pull my credit. And after they pull my credit, my score is going to drop, and I don't want my score to drop. And that's completely understandable, because it is true that when you go to apply for a loan, as a lender, we do have to do a hard inquiry on your credit score, on your credit report. When we pull that, you will more than likely see a drop in your score, anywhere typically from 2 to 5 or 6 points. Now, this is not the same as having a late payment, okay? With a late payment, that is a negative hit against you that stays with you for years and will affect that score. So that drop stays around for a while. With a hard inquiry, you will, as long as nothing else changes and you continue to keep the low balances that you have and pay your other accounts on time, your credit score will rebuild itself within 30 to 45 days. And the reason it's set up like this is they don't want a borrower to go out there and literally get a bunch of loans from a bunch of different lenders all at once before the credit reports and the credit bureaus are able to speak to each other and realize that that person has taken out so much credit. So that's their little backup factor, their little way to keep people from doing too much too quickly. So what I recommend is, if someone is serious about getting a house and they are in search mode, it doesn't matter if it is a month from now, right now, or 3 months from now. I would say have them speak to someone sooner rather than later, because when the report is pulled, it's going to be good for 90 days, sometimes a little bit more. 90 days is, I think, typical. So that report will, even if we have to pull it again, your score is going to be replenished again, as long as you have not done anything negatively against yourself. So as long as everything's paid on time and those balances have not changed or gone up, it will replenish itself. This is the only way that we are able to make sure that you qualify for this loan. This is the only way that we can make sure that there are no surprises that are going to pop up, because it happens more often than not. Believe it or not, you'll have somebody who they believe they have a fantastic score. Their debt is very straightforward. They don't have anything. Don't look at my credit until I am under contract and ready to pull the trigger. And then all of a sudden we go in there and there's something that will blow up. And it could be something as simple as maybe a social security number issue. I actually had a borrower recently that there was nothing wrong with their credit at all. However, when we pulled it, one of the bureaus did not recognize their age for some reason, and they were pulling up as a minor. And it doesn't sound like a big deal, but the amount of time back and forth getting that straight with the credit bureau did set them back over a month. So you just want to make sure you're handling all those things. So don't let that part scare you. Talk to a lender. And like we said before, there's many times where the lender, if they're doing a simulation of the credit, they can actually increase your score quite a bit before you close. So it's even better, a better situation for you. And that is the top myths that I hear on a regular basis. So if there are any others that you hear and you want some clarity on them, please feel free to reach out to me. I'd love to clear that up for you. Credit is a very, very complex situation. And there are a lot of questions and there are a lot of misconceptions about it. So the more we know and the more that you can educate your clients on where these numbers come from, what are they looking for, what are you trying to do, the better chances you have of getting them to the closing table. So I hope that answers some of your questions. I hope you learned something today. I hope you have a fantastic rest of your week, and I will see you on the next one. Bye-bye.